Hey everybody, John Ray with Jade Protocol, NF Treasure, and Smarter Coin again, joined by the professor, Kyren Cater. He's teaching us all about tokenomics, and he and I are unpacking really how to analyze the tokenomics of a project so that you can determine if it is actually a project that matches your investing goals and risk profile. So today we're going to be getting into somewhat of a checklist and just some terms and things that you can choose to look at as you're analyzing new projects and as you're looking at projects that are being built or building your own. So Kyren, what do you got for us?
Yeah, John. So the previous video, if you watched that one, we discussed what are tokens, coins, and basic things like that, sort of the essentials of tokenomics. But now I want to get into, as John pretty much alluded to, like what does it take? What do we need to look for? And my first point of call is always observing if the token or project is a security or not, or potentially will be classified as a security. Now, this falls under the token category, and it's really, really important to look for, because if anyone's familiar with XRP and what's happened with those guys, they've actually, the SEC, which is the Security Exchange Commission, have actually come in and pretty much said that we believe you guys are classified as a security. They didn't classify themselves as a security initially, and this has caused a pretty stagnant, result in price. They haven't really moved in price for a long time, and something like this occurring for a project you're potentially looking at, a very, very small token or coin, would be devastating. Matter of fact, it would pretty much kill the project. And I have an example I want to share with it later on with a project that I was invested in that fell under a security midway through sort of what they were doing. And as a result, they had to change the USP and it killed the project. So I think...
So I'll pause you there and just reiterate that it can seem annoying when somebody is like giving definitions about something. I just want a 10x. Like I think there's sometimes an adrenaline soaked, more hyper emotional way of investing, and as we're seeing, it can get a lot of people in trouble. And the more that we can build out a framework for how to analyze a project and really understand some of the categories and components of the project, the more that we can see and kind of have a prescient vision into the future of what some of the potentials for a project might be. And a big red flag until we have regulatory clarity is that if something is clearly a security, that regulatory clarity, that arm of the government, no matter what jurisdiction you're in, eventually is going to swing the hammer down on those projects. And as Kyren mentioned, that can be the death of the project and created a death spiral in price action that is not comfortable in the nervous system. And so we can avoid all of that by just right up at the start deciding, is this thing actually a security? So let's talk a little bit more about the Howey test and what that looks like.
Yeah, and look, John, I'll be honest, it's quite complicated to get into the Howey test, because there's a lot of gray areas with this, and it's something I'd say this a lot in every aspect of my life, but I really do think we should make our own video on this and really break it down for people, because it's a lot more than just is it A, B, C, or D. Because, as I said, lots of gray areas involved. But first thing you do to identify if a potential project is a security token or not is you come to what's called the Howey test. Now, the Howey test actually provides somewhat of a framework in not just in cryptocurrency, but also centralized finance as well, to analyze whether a digital asset, or as I said, centralized asset, is an investment contract, and whether it offers a sale or offers security transactions. So the Howey test is comprised of 4 prongs, and they're here. So 1 is the investment of money, 2 is the common enterprise, 3 is reasonable expectation of profits, and 4, they've listed it as just 3, but there is 4, is derived from the efforts of others. And I mean, we can read the examples of this. The last one does go on for about 3 pages. So again, complicated topic, but this is very integral. And this is where I always start my research, because if you're looking into a project and you come to the Howey test, you familiarize yourself with it, you've read through it. Again, as Jon said, you're going to be rolling your eyes at this going, my God, I have to read a whole heap of this, 3 pages. What's this guy telling me to do? Trust me, it very well could save you a lot of money. And the more you read it, the more you apply it, the more you're familiar with it. But come to this page, observe if the token is a security and they're providing services that also are securities, then I personally, and then this is it's not financial advice, but I strictly stay away from that project unless, as we said in the previous video, they have claimed that they are a security token, and that means that they are willing to be regulated and fall under some sort of jurisdiction.
Yeah. And so really a big part of this is there one central bottleneck within the protocol that if that person was hit by a bus or if they stopped promoting the project, would this project completely die? Or are there many mechanisms of community involvement and people who are holding wallet IDs and have access to the protocol, open GitHub repositories? I mean, a big part of what I'm researching right now for NF Treasure and for implementing a deeper level of DAO tools into Jade protocol is just making sure that things like Governor Alpha and a lot of the technology that allows there to be no central point of failure, meaning that if one person drops out of the project is not going to die, and the investors are not going to be abandoned, and really making sure that we're creating the right safe holds where there's a certain amount of liquidity locked, especially early on in the project. One of the reasons that we got the Paladin certification and the RugDoc liquidity lock certification when we launched SMRTr was to provide that level of assurance that there's going to be liquidity in this token for at least a designated period of time. And all of these things are judgments or questions that you want to be asking about a project. And a big part of that is just, is there at a minimum a way for you to raise a question and get an answer, and potentially elevate that to the level of a proposal? Yeah,
exactly. You gotta cross all avenues, and that's a part. And Jon's obviously researching every sort of part of it, having to look at everything from every possible angle for NF Treasure as well. So you're hearing it pretty much from the horse's mouth. This is what it takes to run a crypto project. So it's always good hearing advice from Jon as well, because what he's looking into is what we should be looking into really moving forward. Look, I just want to finish up with the first section of this video and say, Jon, that, as I said, this is a very big gray area right now for whether a token is a security or not. But I'm not too sure if you're familiar or not, and you can let me know. Is it that actually Coinbase has created somewhat of a framework to help cryptocurrencies identify if they are securities or not? But at the moment, that's not sort of, it's not technically legal. It's like, here, we're going to give you guys sort of a 1 to 10 questionnaire to see if you are or not, but there's no way it guarantees anything. But I've got some good news, and that's actually there was a bipartisan crypto bill that has been proposed, which actually states that, if I can find it somewhere, there's a whole heap in this bill, but more or less they want to give a framework to cryptocurrencies to whether they do fall. Here we go. Defining guidelines for differentiating cryptocurrencies as commodities or securities. So most would fall under the commodity category according to the bill, which is a good thing. We don't want to be a security, we want to be commodity.
And what I would say as you're researching projects is, a lot of times, like you said, there's a gray area. There might not be a clear yes or no to whether something is a security, but one thing to look at is the team aware that this regulatory clarity is going to be coming at some point? And do they have legal counsel? Are they working towards doing the best job that they can within the guidelines that we have, which are not good guidelines, to determine how to set the protocol up for the future? And one of the things that is a KPI for me, and that I'm really looking to implement in a big way over the next 90 days in NF Treasure and Jade protocol, is really doubling down on our effort to make sure that the community understands how to raise an idea to the level of proposal and then move that to an on-chain vote, so that the community truly is driving the project. And from every step of the way with NF Treasure, I've tried to bring all major decisions to an on-chain vote. The project was started from community proposals, and so you could always argue with any project: is it a security? Is it not a security? Do we have regulatory clarity to even determine that? But I think if you see that a team is willing to iterate and spend the time to research and make adjustments to the project to fall more and more in line with regulatory clarity as it comes out, to me, that's good faith. And that showcases that if other factors check out as well, maybe this is a team that I want to go for the ride with. And maybe I'll learn something about regulatory clarity as they're figuring it out themselves.
Yeah. That's always the first place to look at anything in a project is the team. It'll tell you everything you need to know.
That's right.
And we're going to get to that, actually, funnily enough, in this video. Now, I want to move on, John. Let's go to something I'm more excited about rather than talking about securities, is token distribution. So this is the as I said before, the bee's knees in terms of tokenomics. So very important to understand. And there's three sort of aspects that I like to look for in when I'm looking through a white paper or any sort of project, wherever they've got it, which is number one, how many tokens are in max supply? And we're going to get to why that's important in a second. Is the token a fair launch token or is it pre-mined? So a fair launch is pretty much when a cryptocurrency is mined, earned, or owned, and mostly governed by the entire community. Prime example, Bitcoin, Dogecoin. We don't typically see this anymore. We more so see pre-mining, which is like your ICO coins, which is pretty much when like a whole heap of coins were previously mined up by the team and distributed to developers or early investors and things like that, which is part of the token distribution that we're looking into today. All these coins are pre-mined.
Yeah. You'll remember, if you've been in the Jade and Smarter Coin projects for a while, fair launch has always been one of the rallying cries. We called out early on in our marketing videos and in our early Medium articles that this was a big problem in crypto, where a team will pre-mine a large percentage of the project, and then once the project is pumping, they will then start dumping those tokens on token holders and investors. And while I am certainly not saying that there shouldn't be a team wallet and there shouldn't be a pre-mine, you just want to make sure that, again, is it set up in a way where it would be detrimental to the ecosystem if that entire team wallet was dumped all at once? Or are there mechanisms in place? Are there agreements either on chain or off chain that have some kind of a vesting schedule or a distribution schedule? And I think we'll get into a little bit more of that. But again, having, you could argue that NF Treasure is maybe one of the most fair launch projects that there could be, because in order to even be involved in it early on, you had to go through the Squid Game of crypto, which was Smarter Coin, and so it was this really interesting kind of token launch through a Squid Game that now, because of community efforts, has manifested as NF Treasure. And so, the same with Jade Protocol, where everybody kind of had access on day one. There wasn't a pre-mint. These, of course, you could argue in either direction. And I think that there are plenty of opportunities where a pre-mint is appropriate and is beneficial to the ecosystem. But if you're not aware of whether there was one and whether it was done in an equitable way for the ecosystem, then you're at a disadvantage. And because crypto is a zero-sum game, somebody who does know that information is going to take your money.
Yeah, it's, as you said, it's not necessarily like a bad thing at all. Matter of fact, like 99% of all the tokens are pre-mine. But familiarize yourself with those terms, because if you see fair launch pre-mine, then you understand, because the project might say, it's we're having a fair launch, and then you try to look for the token distribution and you're like, hang on, where's this project's dodgy? No, they're pretty much saying that it's coming up and this is how you participate. But entirely pre-mining your tokens entirely depends on whether it's good or bad. Entirely depends on who you're giving and what percentages and when they have access to those tokens. And that was pretty much the third point of that, was who has access to what tokens. So it's a pretty small list, but it's very, very important you understand this is the more or less a starting point into tokenomics. And the reason why knowing the max supply of the tokens is imperative is because this typically works hand in hand with like burn features, inflationary measures, and general use of the token, which is we're going to actually touch on in a second, so you'll know why it's important. And the other thing is, look, a large percentage of tokens going to what I actually personally call third parties, which are the people that can sell the token whenever they want, like the team investors and advisors. Means that they can literally dump their tokens at any point in time, obviously causing a cascading effect. We can quickly capitulate from there, and it's never a good sight at that point. So always ensure you check the distribution. Now, I want to go into some general percentages and show some examples now of 3 projects I'd like to use to give you guys some idea of what to look for. I might pull it up on screen now, and if we just go here. So first of all, we're going to start with a project called Karura. And before I get into their distribution, I want to say there is no perfect or really good distribution for any project. There's no like standard set of rules you people follow. It all depends on the project. And if we can take Karura, for example, these guys were a parachain on Kusama. So naturally, I'm going to give you some percentages. They couldn't abide by these percentages because they had to supply such a large amount of the distribution or the equity of all the tokens to actually securing that spot, which did warp percentages out. So I want to reiterate, the percentages I'm going to give you in a second aren't like the gold standard. It can definitely change, but again, the most important people we need to observe is the team, the advisors, and the investors. And these 3 are I personally think, John, correct me if you think otherwise, I believe the team shouldn't go anywhere to above 20% of the total distribution. The advisors, I believe, shouldn't get any more than 10%. Again, 11 or 12%, that's fine. And venture capitalists, I want to keep at 25%. What do you think, John?
Yeah, I mean, it's arbitrary, right? Like a lot of it depends on what the vesting schedule is, when those tokens are issued. Are they pre-mined, or are they mined over the course of the project? So, like you said, there's not really like a gold standard for what these distributions should look like. One of the things that we definitely want to understand is what are the supply-demand equilibrium levers within an ecosystem. So if something is massively inflationary and the team has 20% and the VC has 20% and the investors have 20%, well, now that's 60% of people that are dumping into an inflationary economy, and that's not going to be pretty when it comes to price action and the community who's holding the bag. However, if there are unique or innovative mechanisms, whether those be burn mechanisms or some actual utility for utilizing the token within the protocol, and if those utilities are increased by initial funding because there's a higher liquidity pool, or because more rewards can be paid out, or because you can hire a better team that is going to be able to actually implement the utility more quickly. Those are all scenarios where it may be okay to have a higher percentage pre-mined because there's a clear plan in place for how that early investment is going to be spent in order to create the right supply-demand equilibrium.
Yeah, and exactly, it can change throughout time. It's never a set whatever they propose, like you can see on screen. As Jon said, they could bring a better team in, for example. They may have an advisor that has a really, really great advisor that they may want to onboard, and he has a certain price. They need to pay that. So it's always arbitrary. It's never set in stone. And Jon made a very, very good point there, and this is the next topic, but I don't want to go into it just yet, which is vesting schedule. All of this doesn't matter as long as there's a really, really good vesting schedule. For example, Jon and I could have a token that might have 95% going to the investors. If that's what we call vested, and we're going to get into these terms in a second, if that's vested over a 100-year period, then it automatically makes me scared to be like, oh, well, this is absolutely fine then, because it's spread out over a long period of time. They're not getting all the tokens immediately.
Right. Yeah, you basically just want to make sure that however the distribution schedule looks, which we'll get into, boiling it down to its bare essentials, a vesting schedule is when can somebody sell the token, and as long as there is enough of a curve on that, it makes it so that even if the investors were dumping every time they're available to, if the vesting schedule is set up properly, it won't be damaging to the ecosystem.
Yeah, perfect. And look, there's not much I want to really go into on these because I don't want to nitpick projects when we're trying to educate. But essentially, I just want to show you, this is what it looks like. It looks different. So every project's going to be different. This is, again, Karura. This is Moonbeam, for example. So they have a lot more, allocations. So the percentages are all broken up. But as we're going to see in a second, you need to understand when you're researching these projects to be able to group certain sections together, because they will, for example, be investors, but they may have different rounds of investing. They split, say 3, 5, 10, 20%, but you need to be able to aggregate that together as a part of your research.
Yeah, and really, I would just be looking for a team that is capable of intelligently speaking to their tokenomics. If there's a reason for the distribution the way that it is, and you resonate with that reason for how they're going to utilize the funds that distribution schedule are bringing into the ecosystem, then really any distribution can be valid if the team has a good enough reason for setting it up that way.
Exactly. So there's never ever a set sort of, as Jon said, you need to dig deeper, and best thing to do is look at the team first.
And the other thing I'll say is that as we flirt with bearish circumstances, there's going to be a lot of projects that will be wanting to reinvent their tokenomics, and that may require a different kind of distribution, and maybe they bring on somebody that has more knowledge than when they first started, because a lot of projects gain traction, and they weren't expecting to take off as quickly as they did, and now they're trying to play catch up to figure out how can we make this thing truly sustainable. I'm speaking from experience here. So making sure that there's communication about the tokenomics and how they could shift and what it would look like to make them more sustainable. If the conversation is being had and community input is being taken, I would see that as a positive. And if there's a confluence of that with other positive aspects in the project, then that's ultimately what you're looking for.
Yeah, this is why it's great having you on, Jon, and I'm learning it as we're going as well, because I'm hearing it from the horse's mouth. You're actually doing this yourself, so it's great to get an insight as well for investors alike.
Yeah.
But yeah, 100%, guys. Always make sure you observe the socials and see how the team is analyzing feedback from the community and putting that into play pretty much, and distributing the tokens accordingly. Now, this is before we move on to vesting. I just want to give you guys an example, because this just goes to show that nothing is ever set in stone. You'll see some pretty popular projects or projects you may be invested in here, and you might be a bit shocked at the percentages that are on screen. This is more or less them breaking down the different sections into the headings, I guess you could say. So, for example, insiders they call here, which includes the team, company, and VCs. So that's more or less the third parties I'm talking to you guys about, and that's in red. So I mean, look, pause the video now. I don't want to go and break this down too far, but pause the video and have a look yourself at some of the projects you may be invested in, and just see who's invested where and how much they've distributed. I mean, Binance, for example, is probably going to shock a lot of people. So is Flow, because most of that is owned by insiders, as they say.
Yeah.
But here we are, and
And again, I think it's just a matter of making sure that you understand how those insiders are being categorized. Are they, with Avalanche, a lot of the tokens issued to insiders are for validators that are actually validating the network. And so, to a certain extent, that insider investment made the network solvent and actually decentralized. And so, these numbers can sometimes be weaponized against the project. And while there certainly is reason for caution when you're getting towards 50% of the token supply owned by quote unquote insiders, I think that one of the things I try to do is start from a framework where I'm going to give the project the benefit of the doubt. And like I said, if they can properly explain what the allocation was for and why it was necessary for the success and quick growth of the platform, a lot of times early investment does benefit investors if used properly.
Yeah. Any research you do, you must validate with other research, because you can take anything out. Look what the media does. Take anything out of context.
Yeah.
So it's good that you pointed out, John. Now it's vesting. This is another fun part of tokenomics. And I want to reiterate what we've just discussed with the tokenomics, talking from like the broadest sense here, is pretty much invalidated until we observe the vesting. And this just talks about what we were explaining then. You never take one thing out of and without validating it. So this pretty much means token vesting itself means that pretty much the tokens that are vested on behalf of the entities in these pie charts, or anyone that's in that owns any equity of the company. And again, we're going to get into some meanings, examples of what we're talking about here, because I'm throwing words around. Another term you'll find when researching some projects is they refer to the vesting schedule as token emissions. Now, they can be two different things, so I want to remind everyone of that. But for the most part, token emissions sometimes refers to specifically mined tokens or inflation or deflationary models. So there can be two different graphs here, but again, for the most part, they're the same thing. Okay.
Yeah, and when we're looking into a vesting schedule, it's really easy to say we have a vesting schedule, and it's harder to make sure that vesting schedule is actually anchored into some kind of a smart contract. And so, obviously the end all be all of decentralized finance is to have everything live on the blockchain and be able to show receipts for everything. That's not always possible. More and more technology is making it available so that it's easier for teams to do that. But, especially for smaller projects like NFT projects that are starting with zero budget, it can be difficult for them to build everything out on the blockchain. And I think one of the things that we're seeing builders do is create DAO tools that allow all of this to happen more easily. But you just need to be aware, do you trust the team? Because ultimately, if it's not written into a smart contract, you have a psychological contract with someone, and that's much easier to break. obviously the nirvana or Valhalla of blockchain is that code is law, and you don't have to trust humans. You can trust the smart contract. But let's be real, like that isn't always possible, and so there is still an opportunity to just recognize that a team is full of good people, and that they're going to do the best to do right by the community, and that as more and more tools are available, they're going to do as much as possible to integrate their vesting schedules or distribution schedules or tokenomics into clear smart contracts that can be audited, et cetera.
You can always just take like historical data for John, like how have they performed in the past when they've come under pressure or something's happened, how have they dealt with that, and are they still continuing? And you'll be able to find a lot from looking in the past.
That's right. In lieu of a smart contract, kind of historical behavior and how they've responded to challenges can be a really interesting thing to notate in our investing journal.
Yeah, definitely. But as John said, there's also code as well. This is in the case that you don't have that, but lots to consider at the end of the day. But now, guys, just for anyone that's probably scratching their head, confused at some of the terms we've thrown around when discussing vesting particularly, let me define some of those for you. So, for example, when I say vest or vesting, it's pretty much the periods that the tokens are locked or progressively unlocked. And again, we're going to go into some charts in a second. When you see the term lock, that means the tokens aren't obtainable in that period. So they'll have 12-month lock, meaning the 12 months where the tokens aren't able to be touched. A cliff more or less is the same thing. So a cliff pretty much means the tokens are stagnant for a while and then they're immediately released. So for example, a 12-month cliff in the context of, not having any sort of tokens available will mean at that 12-month period, a certain amount of those tokens will be immediately available.
Yeah, and I would say that a cliff can sometimes be a series of locks. So no tokens are available for sale to a certain point. At a certain point, the largest percentage are available, and then there's kind of staggered locks that release the rest of those tokens over time. And so these terms are all describing when can an investor or a team member actually sell the tokens? And the reason that that's important to know as an investor is because when somebody, if you watched our video on liquidity pools, when somebody is putting their tokens into the liquidity pool and pulling out something else, that means that there's price impact and they're selling into the liquidity pool, which you hold tokens in. And so we want to understand when are those periods going to be where tokens are unlocking? Because even if there is a heavy investor ownership in the protocol or distribution in the protocol, if we know when the tokens unlock, we could still maybe ride the wave and be one of the smart wallets that get out before those tokens unlock. And so this is another game that people play is they look at the token vesting schedule, they plot it on their calendar, actually put it in their calendar. And then because 99% of the market has no idea when these dates are coming up, they front run to some extent when these tokens unlock and are able to, it's part of their investing strategy. So whether you take that strategy or not, you need to understand that other people definitely are. And in a zero-sum game, if you're losing, if somebody's making money, it means somebody else is losing money, and you want to be on the right side of that trade.
It's funny, guys, because John doesn't know what I'm going to be necessarily talking about in a lot of these videos, but you always seem to hit the nail on the head with where I'm taking things. And this is something I've continually talked about on my own channel, is finding where tokens are unlocked at certain points and literally plotting in your calendar when that's going to happen, but then also taking a step back at the macro and, for example, checking out like the stock to flow model and going like, okay, well, in 18 months, we're probably going to be at the halving. So maybe these guys aren't going to dump their tokens, hoping that it goes up. So then that's fine. And lots of little situations can play out like that. Also, global economic, problems or anything can sort of weigh into that. But as Jon said, you can really get technical with it and plot in your own life when you might want to hold or buy or sell the tokens.
Yeah, and this is a great habit to get in, is to put things on your calendar, whether it's an NFT mint drop, whether it is a token launch, whether it is when certain tokens unlock or the investors vest. If you are someone who takes the time, and it really only takes like 15 minutes to figure out what these dates are and put it on your calendar, you will be ahead of 99% of the marketplace. And almost every pump and dump group and crypto promoter, all they're doing is they're just plotting this stuff on their calendar, and then they're making calls based on that. And then it makes them look like a genius when all they did was just look at the calendar.
Yeah. 100%. It's like, but then you got boasting rights as well. So there's actually, now that you've said that, Jon, it's probably going to get off topic anyway, but there is a website called CoinMarketCalendar, and it's like CoinMarketCap, but it's got like the community enters in specific events that are coming up for any sort of project, and you can go in there yourself, type in whatever project you're looking for, and then plot that or save that in the calendar, and at least you have an idea of how potentially important a specific event is going to be, and take profits at that point.
Yeah, it's finding the websites. What's the one that you mentioned?
CoinMarketCalendar.
CoinMarketCalendar. So finding websites like that give you mint dates, token unlock dates, any project launch date, having these things in your calendar will really increase your ability to ride certain waves. And to link it back into what we're talking about today, just knowing the vesting schedule, because having it on your calendar serves two purposes. One, you want to know when momentum is going to be coming into the project. And so a lot of times official dates are either the start of that momentum or the end of that momentum. And if you can properly identify which side of the momentum curve they're on, you can enter and exit your position in a way that can potentially be a lot more profitable.
Yes, 100% exactly right. And I might show you guys some examples now of some of the terms we're talking about, but most vesting schedules will have dates at the bottom. So always observe that they always typically just round the dates out. So you'll have to do a bit of calculating yourself, or a lot of them will actually have like the dates or specific time periods up here, and they'll have like when they come unlocked. So they might have 5 months here, but they initially started when the token launched, at the launch of the token. So then you'll just have to figure out when the token launched and work from there. But you have other examples like Moonbeam in this case, which don't have any pretty colors and charts, but this actually gives us a lot more information in terms of when certain tokens will be unlocked. And so you'll be able to find a lot of it in here. So a lot of the terms Jon and I have mentioned will be described in this sort of document. And different projects use different terms. For example, cliffs, locks. A lot of them will mention being liquid. That just means having access to your tokens. Linear, obviously linear meaning the tokens being released in an orderly or predictable way for typically a certain amount of time. And oftentimes in sort of documents like this, you'll find that they have like daily, weekly, monthly, quarterly, half yearly, or yearly vesting periods, which means that the tokens are then like distributed evenly, so linearly over the course of that time. So I get that what I've just said can go over your heads very quickly. So maybe just re-listen to that, do some extra research if you need to. Maybe, Jon, you can describe it a little bit better than what I have.
Yeah, well, I think linear vesting is a term that's been thrown around our ecosystem for a couple of reasons. So in the upcoming Jade bonding event, you're basically going to be bonding your JLP, USDC, or AVAX into Jade, and in exchange, you will be receiving Jade on a linear vesting schedule. That vesting schedule is daily, and so there's 365 days in a year. So if you get a 1-year bond and you buy 365 Jade, well, then you're going to that's going to vest at a vesting schedule of 1 jade per day. And so that's linear vesting. With NF Treasure, we're going to have, I think Avicenna called it clamshell vesting. It's still linear vesting, but the vesting period is in real time. So your treasure allocation that is determined by your diamond tier and basically how you played the Squid Game of crypto smarter coin, that determines what your total allocation will be of treasure, and that treasure will be distributed in real time. Basically every second you'll get a little bit more over most likely a 90-day period. We haven't locked that in totally, but it'll likely be a 90-day period. So every second you'll refresh the game, and in your claim window for that vested, essentially it's a pre-mint for those who played the smarter coin game. You'll be getting a little trickle of that over time, and over a 90-day period, you receive the entire amount. And the reason for that is what we're talking about. We don't want a bunch of people who played the smart coin game to get all of their treasure allocation on day one and then dump it all and completely break the supply-demand equilibrium. And so by distributing it over a longer period of time in little tiny chunks at a time, and by, of course, creating proper game dynamics and game theory, the idea is that we will create more demand than supply, which in an ideal world, theoretically gives us price action in an upward direction.
Yeah, and you could talk also about inflation and deflation at that point as well, because normally you'll hear about that at this point as well.
Yeah.
In this point in your research, and even inflation is very important in some projects, but it's not always a bad thing. As Jon said, there's a strategic reason why it's done. Now, you need to obviously understand when it's good and when it's bad, because there is definitely a difference. But I want to let you all know early that there is always a reason why tokens are set at different times. Understanding why the team has done that is very important. So before we move on, I just want to give you a very quick image example of how it can look different for each project. This is convergence. So they give a different sort of less appealing on the eye example, but still better than reading text. So anyway, guys, I think that pretty much covers the basics. Now, I was going to go into examples of sort of what I potentially look at when I'm checking out the vesting schedule. I want to make it quick, nice and easy, so you guys can we can leave some examples for the Learn to Earn course. Number one thing I think is important, and again, Jon and I have touched on this. The team, in my opinion, has to have one of the most, if not the longest, vesting period. But again, that does depend on what they're using those tokens for and what defines a team. In my eyes, the reason why I like to look for a team to have the longest vesting schedule is because then they have the most skin in the game. And it gives anyone in the team incentive to continue building, because as they continue building, it's going to obviously, the token price should hopefully go up, and that's more of an incentive to stay. What do you think about that, Jon?
Yeah, again, I think there could be a reason to not have a vesting schedule, but there needs to be deep clarity on what that reason is and how those funds are being utilized. And at a minimum, you want to know, are they planning on dumping the entire bag? Like that's not something that would be appropriate. But having an agreement where they're taking a certain amount in order to pay expenses or salaries, especially on smaller projects that don't have a big investor. I mean, these can be beneficial to the project. It's why people do it. And it's really one of the most interesting things about crypto, and why crypto is probably the best fundraising mechanism or bootstrapping mechanism that the world has ever known, is because you can have a good idea and garner a community and community attention around it. And through that attention, you can figure out a way to actualize your idea and bring everybody up with you. And so of course, developers are expensive, and there's a supply-demand equilibrium on developers. There's actually, it's hard to find a good developer that actually has the time to work on your project right now, because they can command whatever fee they want, because everybody's trying to build a crypto project right now. And so with that in mind, if having a team wallet that is taking a certain percentage of that wallet, and in a responsible way, selling it into the liquidity pool in order to bring on top tier talent, that might be a trade-off that long-term pays off, because if the utility of the platform isn't there, then it doesn't matter what the tokenomics are. And so you have to have somebody that is smart enough and talented enough to actually build out that utility. And great utility can far exceed any detriment that selling small portions of a team wallet into a pool might create.
Yeah. So I think moral of the story, we can for sure say that, just make sure anything you see or read is most definitely validated by looking into what the team are doing, particularly because again, they could have all the right intentions and one thing's taken out of context and it looks really bad. And you don't want to miss out on that really good investment as well, because you've missed over an important piece of data.
Right. And I would say, with larger projects, in the DeFi space, like having a more stringent vesting schedule, maybe some clear definitions on what that looks like, vitally important. Where, with NFT projects, a lot of times it's a way smaller group of people that are putting the project together. Oftentimes it's people who just love creating and love art, and they really are doing it, from a good place in their heart. And they may not necessarily, they may be learning crypto as they go too. And you just need to know where the team is at in their learning curve, because it is really cool I've been in on some NFT projects where we were all learning together. Nobody really knew exactly how to do it, and the community got to be a part of that process. And in a project like that, like, you want the team to be incentivized to put in those hours, because in a small project, team members are sometimes putting in 18-hour days. That is not uncommon for somebody to be wearing 19 different hats. And if that's the case, and if the passion is there, and if the story of the project is interesting to you, then, these are all judgment calls that we get to make in crypto. And a lot of it depends on your timeline, right? So some temporary downward price action, if it means that the project really gets built out and the vision is completed in a meaningful way, might be relevant and might be something that you can stomach based on your timelines. But only you can know your timelines. And if you don't know your timelines, then that should really be the first thing. And what I mean by know your timelines is, when do you need a profit on this? Are you trying to buy a house next year and you need this as a down payment? Or do you have 5 to 10 years to wait some of these things out and allow them to come to fruition?
Yeah, for sure. You've got to assess every possible angle. Why am I investing in something? And how does that also correlate to what the vesting schedule looks like?
Yes.
If you're relying on that for any purchase. Exactly right. And I suggest everyone when you're looking at the team, again, it's the first point of call, check out AMAs, read Medium articles. You'll get a good feel of who they are and who they are as a person and where their heart lies. And that's all I want to really say about that, because we're actually going to get into that in a little bit as well, because that's the first place I tend to look as well. Before we do, very briefly, advisors, because this is the third parties I'm talking about here. So we've talked about the team. Again, do your research into the team's morals. The second is advisors. So I believe the advisors are more or less aligned with the team. These guys are more incentivized by money. Of course, that's why they're advising. Not always the case, but a lot of the case sometimes. And investors. Now, these are the real scary guys, because you need to make sure that they don't have access to a large cliff or unlock of their tokens at strategic times. And if they do, as Jon said before, you need to mark that in your calendar as a potential dump or sell-off period. And I would look, if you're in profit, to possibly take profits. Again, not financial advice, but most definitely the investors, are the most concerning aspect of the third party that I look for. And you need to pretty much just assess every possible angle. Macro, where are we in the current market? Again, check the stock to flow, check current economic status of the world. Again, this could potentially be very boring information for a lot of you. I guarantee you, when you start making money, you'll be coming back and saying a different thing. But more or less, it does get a bit boring sometimes. So again, make sure the investors have their tokens spread out on a nice linear path over as long as possible.
And in a lot of projects, the investor wallets will be doxed. And so if that's the case, I would definitely look at past on-chain history. A lot of time the investors are known in the space, or they have some kind of a track record in the space. And so what other projects are they invested in, and how did they handle those token distributions? I mean, this is where it can start to get time consuming to research a project. But if you're really looking to set yourself up for success, knowing these things makes you a valuable part of the community, because then you can share that information. And in a decentralized community, the community is the greatest asset. And part of that is because there is an information flow that could never happen if everybody was just siloed off. And so in addition to contributing funds in whatever way to a project, one of the ways that you can provide massive value to the community and help your fellow crypto investors is to decide, okay, you know what, on every project, I'm going to go and trace the history of the investor wallets, or on every wallet, I'm going to put together a Medium article that showcases how I'm thinking about the vesting schedule. And that's your contribution to the community that then everybody in the community benefits from. And you can build a reputation for providing really good, solid information like this. And it's oftentimes more satisfying than price go up. I mean, don't get me wrong. I love 100x like anybody else, but day to day, what I love most about crypto is that I get to use my unique talent stack to contribute to a community that finds that meaningful. And I highly recommend that somebody follows that loop at least once in some crypto project. Go the extra effort to put a little elbow grease in and provide meaningful information to a project, and then just give it to the community and as an act of goodwill. And that's just a fun way to build community and to build peer relationships.
And you're learning at the same time, which is, as Jon said, it's almost as satisfying. I was almost going to say just as satisfying, but I don't know about that, as a good 100x, but it's still very, very rewarding. Yeah. And I just wanted to bring this up before we move on. As Jon said, you can check if the investors have publicly doxed their address on any sort of public scan. So this is Etherscan, you got AVAX, things like that. And you can go down to the token itself and have a look. You'll have these are contracts, and you can see percentages, who owns how many tokens and things like that. So you can go through and have a look at that yourself and figure out, distribution from there, and see if they've sold their tokens.
And what we're talking about with tokenomics and what Kyren and I are hoping to convey in all of our videos in the Crypto Visionaries series, is the value of data, right? And a big part of where I see NF Treasure going, the treasure box game that we're launching with is just the bootstrapping mechanism, where we can really make a meaningful contribution to the crypto space is by providing on the NFT marketplace page meaningful data that allows people to find all of the stuff that we're talking about without having to hunt it out. And I'm really looking forward to being able to provide cool data visualization in a way that puts all of this in front of you when you're sitting on the page for a particular NFT project, so that you can become a more informed investor and make, hopefully, theoretically, more profitable decisions.
Yeah, and that's what it all is. And if that requires you guys to go on and write a Medium article on a project, then that's what it requires. But always try to learn and never be afraid of criticism, because you're always going to get criticism. And I try to take it on board as much as I possibly can. That's why Jon and I share the same sort of values in our communities as well. Where it's always about, let's try to uplift everyone, not tear each other down based off where our current knowledge stands.
That's right.
Now I wanted to move on, Jon. And we're going to have to be quick with this one. But regardless, we're going to touch on this in our next video, which is pretty much it's network defensibility and network effects. But the token itself is a very, very integral part of that. Matter of fact, it's at the center of that. So I felt it somewhat necessary to at least tell everyone about, so you guys knew what to look for when you were researching. Unfortunately, I'm having a bit of technical difficulty, so just give me 1 second. Okay, guys, so network defensibility is very, very important. Now, what do I mean by network defensibility? Well, essentially, you could say it's more or less everything in crypto, because as we know, crypto is open source. Anyone can copy and paste code. It's just a standard in crypto, having everything provided to the public, so we can all view smart contracts. Not that any of us can all read code, but it's there and available. So without network defensibility or intrinsic value in the token itself, which comes back to utility, then all you have is pretty much a useless fungible token. And I want to read you the example of what defensibility actually is, but one of the guys who I learned this off initially, and he says that the ability to maintain over a period of time a positive rate of return for a business or a network, in this case it's a cryptocurrency network, that somehow doesn't get competed away by another business or cryptocurrency network. So how do we keep that value in the community? How do we make sure that no one just leaves? How do we make that token worth something to everyone? And another way we could kind of phrase that is, what is it that creates a moat around the value that is being created at the heart of the network? And the heart of the network is the token, at least in my opinion.
Yeah. And it's kind of like every project has like this force field to it that's bringing people into the project or spitting people out. And ultimately, like, defensibility is, can this project properly defend its utility, right? Like, one of the reasons that I feel OHM Forks had such a fatal market capitulation, where they all dropped 50 to 99%, is because anybody could copy and paste that code and create an OHM fork. And so, at the peak of OHM fork season, we had, at least 50 or 60 protocols that were basically all offering completely unsustainable rewards, and people were just hopping from billion% to billion% APY protocols. And so, one of our early Medium articles in Jade called out that the backed price and a lot of the mechanisms within OHM Forks were actually faulty and would ultimately fail. And then they did. And the reason was because they did not pass a network defensibility test or a protocol defensibility test. So it was too easy to create the same protocol and too easy to just draw loose money in with an ad that said, oh, they've got 1 billion% APY. We've got 4 billion% APY. And ultimately, that was a house of cards that, as we all know, crumbled miserably. However, the protocols that were using that bootstrapping mechanism in order to build out a solid team and utility, Jade's utility being the investment treasury and the floor price with Buybot defending that floor price, we can see now 5 months later that anybody who has dollar cost average and gotten their cost basis down to the floor is in great position, while the rest of the market is in an absolute tailspin right now. Jade has maintained its price and even been up on days where the rest of the market is down 15 to 30%. And part of the shift in Jade protocol was because there was a protocol defensibility thesis. And the thesis was, if we do what every other ohm fork is doing, we won't survive. And so there was a pivot point to make sure that we were anchoring in a defensive enough way and building out a team that could ultimately design something like Jade that is actually designed to weather a bear market.
Yeah, and the ohm forks is a spot on, prime, perfect example of this exact situation. Anyone can just copy and paste anything, but the reason that made ohms, well, the original chain so valuable was because it had the defensibility there. Like anything, Jon and I could go get a developer and copy and paste the Uniswap code right now, but what makes it valuable, why people want to provide liquidity to it, and things like that. And it all goes into exactly what we're about to talk about and what Jon said, prime example. And it's always good, in the Jade example, to look at that and go, okay, well, or any sort of project that's possibly, forked chain, is to go, well, if it's failed or something's happened, how have they managed to restructure and navigate back onto the path that they desired to go on? And, look, guys, we're all human. Like, at the end of the day, mistakes can be made. As long as the team, and this is what I'm going to touch on now, sees that and, advises the community on a way that they're going to move forward, then they're showing passion and commitment. And that's something that you should really take on board, in my opinion. And that's what I look for when I invest, okay?
That's right. And look, the defensibility is something that can be applied later on in a roadmap. Like, sometimes loose tokenomics that bring money into a protocol is the bootstrapping mechanism that is required. Riding whatever the current crypto wave is can be the way to accelerate, a project to a level where it can actually fulfill its utility dream. But as we know from early Medium articles and marketing in Jade, there's got to be real effing utility on the back end of that. And there needs to be a plan for that Ponzi to ultimately reach what we call Ponzi escape velocity and utilize the protocol in a way that cannot be duplicated just through copy and paste.
Yes. Yeah, exactly right. Now, I want to just finish this flywheel for anyone who's interested in why the token value is important. And you see it at the right of the flywheel here, but I do see it as the center because it all starts from there. But as Jon and I have touched on, and I've said this whole entire video, is the founders and the core team are what create the meme and the protocol itself. The stronger the idea and the more conviction the team has, the more fruition this is going to create, and it pretty much births the ecosystem. So that's where everything starts. So the founders and the core team, the protocol idea is created. Investors produce financial capital, which together create token value. There is now value for the token. Then, because there is token value, miners and validators want to provide production capital because they want some of that token value. They want some rewards as well, and they see that. So they provide production capital. Again, they stake or they mine, whatever that may be, validate the chain. And that creates platform functionality. From there, with the help of third-party developers, providing human capital, building the ecosystem up, creating those layers of the blockchain, And kind of like AVAX, Ethereum, all these different chains, Solana, they've created an ecosystem, and the more developers that come on board, the more third-party developers that jump in and see the use there, see the token value. They create the ecosystem, therefore they create utility for the end users. And then, as Jon has said, the community must also provide it back into the flywheel because then that is what keeps everything moving forward, of course. So, a prime example of this, I wanted to show two very, very brief examples of what I mean when I say down here, third-party developers. It all starts at the token value, but if I just quickly get my screen up here and show you all, it's really interesting because two projects I'm quite heavily invested in have recently done this. So we've seen Moonbeam, which is one of the examples today, launched a $100 million growth fund for Moonbeam. I think Avalanche actually had one recently as well, which is great. And Mina Protocol, $92 million funding round for ecosystem development, which has in turn brought more developers on board because they want either grants or they want a part of the tech, and then the whole flywheel continues. But token value is number one.
Yeah. And making sure that, especially with these layer ones, that there is some kind of outreach program like this that is educating people and providing resources and making it easy to develop on the network. Avalanche has been good at that. Obviously, Ethereum has so many resources just because it was kind of the first thing that people were building dApps on. And those resources are important. And if it makes it easier for you to build a project or you to research a project because those tools are already there, that means other people are thinking that same thing. And so you want to make sure that the developer community is happy in whatever, platform you decide that you want to invest in, because if they're not, the chain's never going to take off. I mean, one of the protocols that's been dear to my heart for a long time is Digibyte, because it was kind of the first protocol that really taught me about true decentralization. But because they're truly decentralized, they don't have something built into their tokenomics that incentivizes developers to come in. And so there's constantly drama between their development teams. And ultimately, a protocol is only as strong as the projects that are built on it. And so looking at these layer ones that are offering these big grant programs for you to develop projects, Avalanche just had one. I think it was almost 300 million. These that you've developed, Cardano has a great developer ecosystem where built into the fee structure and tokenomics of the ADA token or ADA coin is a mechanism for money to funnel into what they call the Catalyst program that then offers grants to developers. So, it's not the only thing to look at, but it definitely showcases whether or not new projects are going to be consistently launching there. And it only takes one or two hit projects to bring millions of people in. I mean, one of the coolest things about the SmartCoin experience was that we had a very small project that ultimately brought, close between SmartCoin and Jade, is bringing close to 100,000 people into the Avalanche network. And so when you think about the network effect of a bunch of projects that can each bring 100,000 users in, that's why the funds are important like this. And that's why it should be a part of a layer one's defensibility strategy. And for protocols, one of the things that I want to see within Jade Protocol is that we offer similar rewards for third-party developers to come in and build out feature sets within the Jade ecosystem. I want to do the same thing with NF Treasure. So on a smaller scale, is each project ecosystem incentivizing the community to be involved as developers? With NF Treasure, we just opened the GitHub repositories. We're allowing community members to submit pull requests. So this is step one in us building out our own developer community.
Yeah, perfect. Because that does apply predominantly to L1s, but if there is the validators and miners that you can sort of move and chop and change depending on the protocol, and more or less that same network effect applies for any project.
Yes.
And you mentioned something about Cardano also, having that sort of that gas or the fees that actually go back into developing the ecosystem, which I find incredible, and that's an important thing as well. And it's very, very enticing for developers to see that, because that's what's going to bring them in as well. And before we move on, John, I thought utility, because that plays into defensibility and what you were saying. This is very important to look at in a project. As John said, the utility of the token could be 3% of every transaction is burnt, or not burnt, but at least given back to or delegated to different parts of the ecosystem. And in the case of Cardano, that's deploying more means for ecosystem expansion. And you've got every project you guys look into will have some sort of page where they go into the token utility. This is Moonbeam. You have Karura, looks a little bit different. And again, Convergence is the boring one this time. But make sure you definitely go and you look into that first and apply that to the entire network effect, and see how valuable that token is, to see if it will kickstart the ecosystem.
Yeah. And for project owners, just understanding that these are all checkboxes that need to be ticked. And you can see just in the few examples that Kyren just showed, some people are much better at showcasing their utility than others. And one of the things that I really hope to bring to the space, and that I know others in the community are excited about with the agency side of NF Treasure, is being able to convey everything that we're talking about in a project and in their marketing in a way that makes it easily digestible by the community.
Yeah, perfect. John, the video is getting on, so I want to just very, very quickly go through supply and inflation and deflation. But I think everyone, if you've made it to this far in the video, let us know down below. And I think John will make videos on these topics individually moving forward, depending on how much you guys want to understand them on a more granular level. Yep. So I just want to touch on supply very quickly. Now, supply of a token does fall in the tokenomics. And as I mentioned at the start of the video, it's sort of mentioned in the token distribution. Why is this important? Well, less tokens normally equals price can move faster. And that's always a good thing, because price is what obviously part of the reason why we're investing in a project. And if price goes up rapidly because there's less tokens, then we're making more money. Bitcoin's always had a finite supply of tokens. It is inflationary, but you could technically argue it's deflationary at the same time. But there's such a finite supply of the tokens, which means, like if, for example, all 21 million tokens are eventually mined in circulation, then if they're all bought, the price is going to be astronomically high, and there's going to be so much demand. And if we invest now, obviously that'll get exponential once all the tokens have been bought. If there's, for example, let's take some examples. I mean, look at AVAX. AVAX has this is actually a low supply, if those aren't familiar with any sort of examples. So 720 million max supply is quite small, which is good to see, which means AVAX has the potential to move up in price quite dramatically if they're all in circulation. And we look at a different example, SafeMoon. Now, the difference is, like, SafeMoon has a max supply of, I'm not going to even try and quantify that number. I think it's like the next above quadrillion. But yeah, so they have quite a large number, and that just simply means that the price will take more capital to move. And there's nothing wrong with that. SMRTr has quite a large max supply, but it's the utility that is behind SMRTr that makes all the difference. Typical coin like SafeMoon, for example, doesn't have utility as much as at the time they said that they had utility. But that's all that matters, is you must sort of synchronize utility with the max supply, because if the utility of the token is to, for example, is for for developers to actually start building on the ecosystem, they must supply 100 million tokens, then that somewhat justifies a large max supply. John, what do you think?
Yeah, I think all of it comes down to what is the token actually being utilized for. And if it is just a rewards token, And Smarter Coin started as basically just a rewards token. In some of the videos, I mean, it literally called it an unsustainable Ponzi scheme. It was a test in what happens when you do things in crypto that you're supposedly not supposed to do, like raise interest rates, raise APR 1% every single minute for 2 weeks. Clearly, the Smarter Coin community understands the negative impact of massive inflation. And it's why we now have a token supply, fortunately, locked with emissions locked at 12.8 trillion. You know, when you look at something like SafeMoon that has 1 quintillion or whatever it is, I mean, 12.8 trillion seems like a low number. And, you know, what NF Treasure is recognizing inflationary and deflationary modalities. And so now that Smarter Coin is locked, we'll never print another Smarter Coin. And the only way to upgrade your key, which then unlocks more treasure rewards in our ecosystem, is to burn smarter. So Smarter Coin is now a deflationary coin. So we went from it being a massive inflationary token to now being a deflationary token, where the supply of smarter is only going to shrink more and more as more features of NF Treasure come online. Theoretically, that's what our thesis is. Treasure will be an inflationary token, and meaning that there isn't going to be a max supply on that. We will always be able to print treasure until the community decides that they don't want to print it anymore. However, in order to counter that inflation, we're building in utility for treasure, like opening the treasure boxes, being able to mint NFTs, being able to participate in what I'm tentatively calling burn to learn. So we're going to have our learn to earn, where you can earn treasure, and our burn to learn, where you can unlock even more content by then burning that treasure. And so creating the right mechanisms to reduce that supply at a level where the inflation, the supply-demand equilibrium, or the inflation of the token, has more demand on it than supply being printed, is the ideal scenario. And we do that by building a business, right? Like, you can have the US dollar is pretty massively inflationary right now, but it still works because we have Navy ships in every ocean in the world, and because ultimately there's a real economy in the United States. So you can have inflationary tokens so long as there is a real economy that is actually producing real goods. And in NF Treasure, the experiment is, okay, well, let's build a real business. We're going to have the agency. We're going to have the data aggregator. We're going to have the raffle swap. We're going to have the marketplace. We're going to have the DeFi game. All of these will have mechanisms for reducing treasure supply, even though they're also creating mechanisms where we're increasing treasure supply. And so what we want to do is just control the rate at which that supply is growing, while pairing that with the deflationary supply of Smarter Coin.
Yeah, and that's a great point, John. Inflation is healthy, especially if the token is designed to be used in a lot of different aspects of the project. And a lot of those tokens are going to either be burnt or locked up for a period of time. You need inflation, otherwise the token is just going to go to 1 or 0 coins, or just never, the price is going to go astronomical too quickly. And it's a equilibrium you must find, and the same goes for deflationary coins. I mean, if you look at Ethereum, there's like EIP 1559, when they started burning tokens and they capped the supply off. Other than that, there was unlimited amount of Ethereum tokens that could have been created. So it's never too late to change that. And this is why it's important as well to going back to the team as well and figuring out where they're taking things in the long term.
Yeah. And this exact issue is the reason that the Jade circulating supply is no longer offering 1 billion% APY. It's not sustainable to have an inflationary supply like that. And so right now, other than bonding events, the Jade circulating supply is capped, which ultimately, as we build out more and more utility, and as the utility of Jade being the treasury, some of those seed bets start to pay out, we'll see that, you know, the thesis is that the treasury will grow from those seed investments. As the treasury grows, the investment treasury can then fund the backing treasury, which then raises the floor price. And as that mechanism starts to play out, the entire flywheel comes together and the marketplace recognizes what Jade actually is. The thesis is that a premium will get built in on top of that, because markets tend to place a premium on futures and on deal flow. That's how VC firms are traditionally priced, is based on their deal flow, not on the actual revenue. And I believe that we have a strong possibility of getting to that place where that premium is priced into Jade. And one of the things that I wanted to mention about NF Treasure is that an additional supply control for any protocol, and the reason that so many have them, is staking. So staking is temporarily pulling supply out of circulation. It means if somebody's staking it, they can't sell it. And so it's just another mechanism for temporarily reducing supply.
And Bitcoin, it's technically inflationary, but a lot of people argue it's deflationary because of that exact reason. Most people hold it, will never sell it, and lots of wallets holding thousands of Bitcoin have been lost, and therefore, by means of that, it's deflationary. So, yeah, exactly.
And it also depends on deflationary compared to what, you know. It depends on the pair. If you're comparing anything to the US dollar, you have to recognize that, you know, the US Treasury just announced that inflation by their numbers is 8.3%. So anything that has an inflation rate lower than that is actually doing better than the US dollar. And let's face it, the inflation rate is higher than 8.3%.
Yeah, it's great. I'm reading a book right now on the fiat standard, and wow, it'll open your eyes up, you know. But that's it. Again, let's say a different video, Jon. Guys, I want to conclude today's video. I think we've summed everything up nice and easy. I think you've gone from everything you really need to know about tokenomics in today's video, but I wanted to leave you with a little bit of a thought-provoking statement. And that is, a rational analysis of irrational processes is bound to fail. What does that mean? Well, one term Jon's used time and time again, and it's taken me this long to sort of implement it into my own research, is a project mimetic. Is it going to stick? And can it be memed? Can it spread and everyone want to use it? And this also goes back into tokenomics as well, because, you know, the token or the project must be mimetic. And if it's not, it's pretty much just like, why have you looked so deeply into the technical details? Again, you know, why are you trying to provide rational analysis if it's already irrational? It makes no sense. So I want you to all understand that what you should really understand first is the project understandable? Can the project or the token be memed? And is it, you know, something that can stick? And
when a memeable idea, which just means it's easily shareable, it's easy to build a community around it, it's easy to get people to stick around. I mean, one of the reasons that idle games are a thing in DeFi is because it's a mimetic idea. It forces people to stay around and build community and talk about the project. And so it's part of the game theory, literally as a game, that makes a project mimetic. And if a project has a mimetic concept, either in the structure, the way that it's gamified, or in the marketing, or better, all of it, and is paired with solid check marks next to all the boxes that we've covered in this video and others, then that's when my spidey senses start to go, okay, this might be the thing to dive into. And then, you know, when I'm thinking about my investments, I'm a builder. And so I'm always thinking about, how can I personally contribute to this project? Can I make videos? Can I write Medium articles? Do I want to run their Reddit? Do I want to go in their Discord and provide meaningful feedback for people there? Sometimes it's more fun to get into a project in its early stages because you can become one of the key players in the community. And so that's just another thing to think about that is not directly related to tokenomics, but certainly plays into how passionately you're going to be willing to research it.
Yeah, I can vouch for that 100%. Yeah. I think that pretty much sums up everything I wanted to say, John. I mean,
yeah.
Unless you have something else that you wanted to touch on briefly.
I think, as always, I've rambled on too much and this video has gotten long. So if you're still here, I appreciate you so much. Thank you for being a part of this community. Drop a line in the comments on if there was an aha moment, if there was something that you still need some clarity on. What videos do you want to see us make in the future? Is it worth us spending our time on this? Are you getting value from it? Hit the like button, the subscribe button, and leave a comment so that we know you want more content like this. And we'll see you in the next one. Bye.
Bye.